Our next speaker, Joe Piotroski, who's come all the way from the US. It's a long way to come, and this is a somewhat different paper, but we're going to be looking at some evidence a little bit closer to home, and that's always more interesting for us who are from this part of the world. So, without further ado, over to Joe Piotroski.
Thank you very much. You may want to hold your applause until the end of the presentation. First of all, I'd like to thank Peter for the opportunity to present at this year's CARE conference. This is actually the second year in a row in which I've had the opportunity to present. As I think I've always said to everybody I talk to, I think this is an outstanding forum, and Peter deserves a lot of credit, and deservedly so, for the outstanding job he's done over the years with organizing these conferences and his earlier conferences on valuation and financial statement analysis. And I'd also, of course, like to thank Professor Young and everybody else at NUS for the funding and, again, for hosting this conference. And so hopefully the paper lives up to all that's been done on our part so far. As Trevor mentioned, this paper is examining issues of financial reporting and information flow in the context of China. It's co-authored with T.J. Wang at the Chinese University of Hong Kong and Tianyu Zhang at City University in Hong Kong. And some of you, I realize, may have actually seen this paper in earlier forms. And if so, I do apologize. For those of you who hadn't, I think this is going to be a really good paper to talk a little bit about an issue that actually might be central to careers in Asia, and that is finding research questions that you have a competitive advantage at. Too much that I see as a referee are non-U.S. academics trying to answer questions about U.S. capital markets. And there are certainly lots of interesting questions to address, but the world is much larger than the U.S. I can't believe I'm saying that, right? The world is not only the U.S., it's not only the U.K. Those systems are very specialized. Diffuse ownership, very strong legal regimes, strong protection of investor rights, well-functioning markets, minimal market frictions. They're ideal settings to be an investor. Unfortunately, large parts of the world don't operate with those same institutional characteristics. And something I've done at Stanford is I've created a course that is designed to try to investigate the question of how do you value firms outside of US, UK environments, and more specifically in developing economies or emerging economies. And this was actually the topic of the talk that I had at last year's conference in London. And the interesting thing about this course is it's forced me to sort of revisit all of the work that's been done in economics and finance and accounting with respect to the role of institutions and economic outcomes. And what you ultimately see when you think about firms operating outside of the US or being traded outside of the US is that we have to understand the institutional environment. And in particular, we have to understand the legal system and the regulatory environment. We have to understand cultural issues, and we really have to understand the political institutions, because those institutions drive everything else that we see happening in the environment. The nature of the legal system, the nature of political involvement shapes the level of protections that investors have when they enter these economies markets. It shapes, ultimately, the risks that investors have to bear when they have claims to these firms. It helps understand the extent to which there could be expropriation, the extent to which there could be corruption, the extent to which there could be mismanagement. And ultimately, we have to understand that these institutions shape just sort of the nature of the way the markets themselves function. How developed are the financial systems? Is there a greater reliance on banks or equity markets, et cetera? The most important thing, though, and this is where, as accountants, this really starts to hit home, is this environment. These institutions and the incentives that they create shape the incentives and the behavior of the firm and the firm's managers, such that the institutions are associated then, drive behavior in terms of operational decisions, the types of investments that are chosen, the way assets are managed. It shapes the strategy of the firm. Firms capitalize on the environment they operate in. They align their business activities to try to maximize the institutional structure that's in place. And again, from an accounting perspective, all of these institutional attributes will shape the information environment shape the financial reporting model that the firm adopts. And so what this paper does, the paper I'm going to talk about today, is try to examine just kind of one of these threads in this larger framework, and that is the extent to which political institutions and political forces influence the information environment of publicly traded firms. And I'm going to do that in the context of China. That's done for some practical reasons that I'll talk about later. But the general notion, I think the general framework is just recognizing valuation is the ultimate goal. The models Peter talked about yesterday still apply. It's just that forecasting cash flows and thinking about discount rates require us to consider a broader set of issues, particularly governance-related issues, that we tend to sort of sweep under the carpet if you're looking at a U.S. firm, or we really aren't at the sort of the forefront of the valuation problem. Okay, so let me kind of jump into the paper a little bit. The motivation for our paper was as follows. There's a long stream of literature, and I'm not going to cite it all, basically showing that institutions influence economic outcomes. And like I said, economics, finance, political economy, accounting, we all show this. From the accounting perspective, the result that's most dominant in the literature is the notion that legal institutions and market institutions that promote investor protections tend to be correlated with, tend to drive better financial reporting practices. Now, better has been measured in many different ways. It's been things such as there's less earnings management, and using statistics that may or may not be valid, but it appears to be that we see less earnings management when there's strong investor protection, strong legal systems, strong market demand for information. We tend to see better transparency. That, too, is a phrase that's a little broad, but it's the extent to which there's analyst coverage, level of disclosure, use of voluntary forecasts, et cetera. We tend to see things such as there's stronger timely loss recognition practices, earnings tends to be more informative, and there's higher use or higher likelihood of the use of a high-quality auditor when you have these strong fundamental institutions. And so this cross-country research has, at least I think, fairly clearly established that there's at least an association between institutions that promote investor protection, and then through some channels, we ultimately end up with better financial reporting. And those channels, I think, are a great opportunity for research. How is it that strong institutions ultimately result in better financial reporting? But that's clearly the association we see. What we're going to do in this paper is really focus on sort of the other half of that previous slide, and that is to kind of get away from the legal story, but instead recognize that politics also matter. And when you start talking about emerging economies, politics and political connections and political intervention and political forces really are a sort of a dominant characteristic of the economy and have the potential to produce some adverse reporting incentives. And so what we're going to do is examine political forces and how they shape information flow, financial reporting practices in the context of China. Now, clearly, there's been a lot done on state-controlled entities and the role of political forces. First of all, I think one of the things you have to sort of get your head around when you work in these environments or when you do research in these environments is the recognition that firms don't always maximize shareholder value. Now, in the U.S., we hope that that's what happens when you have a good board of directors and good corporate governance, is that the managers' incentives are aligned with that of the owners, and you get a value maximization type of philosophy. But when you move outside of the U.S., that typically isn't the case, and it's because of the fact that the policies, first of all, the policies of the state aren't always oriented towards maximizing value, but there might be some other political objectives, some of which may be kind of rent-seeking type behavior, but some of which could actually just be harmless in the sense of it's about full employment concerns or having a welfare system that's functioning, even though that may not maximize shareholder value, it sort of maximizes societal value. One of the other things that comes out of sort of the finance literature is that politicians who control firms frequently, again, don't maximize shareholder value, but use the control of these firms to achieve some other benefits, such as private benefits of control, or they use the firm as a means of rewarding political supporters, as a means of promoting cronyism. And so what you have are firms that, again, aren't acting optimally. You have a set of politicians who are using the firms to achieve some other alternative end. The end result is you have firms that have weak corporate governance practices, and they behave very, very inefficiently. Their performance lags that of non-state-owned firms. They tend to have inefficient investment behavior. They tend to have poor asset management skills. And some of the activity inside the firm could best be characterized as rent-seeking in nature. It's in this context that we want to answer the question of, well, how do these types of political problems shape the kinds of information the firms under their control produces? There's also another big problem in the literature when you talk about state-controlled entities, and that's the fact that you have this just enormous agency conflict between the majority shareholder, which is the state, and the minority shareholders, which are us, who are providing capital to the firms, but letting the state effectively decide how to use that capital. And so, of course, you have concerns about, are the resources being tunneled out of the public entity to be put into some other state organ that isn't publicly traded and have the funds basically diverted. Now, as you'd expect, there's been research on how political factors shape accounting practices. The seminal paper in the area is actually sort of a US-based paper. It's Watson-Zimmerman, looking at how accounting choices are influenced by the expected political costs of certain reporting outcomes. And in their story, it's really about taxation. Firms that report too high of profits could potentially be subject to windfall profits tax. There could also be some backlash against industries which appear to be earning economic rents at the expense of some constituents. But I think more broadly, political costs simply mean that the firm, by reporting a good outcome or by being perceived as being too wealthy or having too many valuable assets, there's a risk that the state is somehow going to intervene in the business operations of the firm. They may impose more regulation upon the firm. They may actually exploit the firm's assets through expropriation. It may mean that there's other indirect taxes assessed on the firm, additional bureaucracy, fees, licenses, etc., that ultimately, by being too profitable or by being too large or by having too valuable of assets, there's a risk that the firm could incur some kind of cost through political intervention. The extant research to date, and there isn't much of it, has tried to look at what do the reporting practices of public firms look like if they operate in a country where the government has a tendency to intervene in business affairs. Now, intervene can be thought of many different ways, but it's basically, do you have a country where the government has shown a tendency to somehow enter the market and change the behavior of or change the business environment. A good example is, hate to do this, but a good example is France. France has a long history of having an interventionist government. And the direction of the intervention sort of depends upon which branch of government is in, if it's lefts or rights, socialists or non-socialists. But what you see is occasionally the French government steps in to prop up poor-performing firms. And that's a form of government intervention. Effectively, decision rights are being transferred from managers to the state. And then in other instances, the French government will privatize and basically say, we don't want to be involved anymore, and we float the shares again and let the public run the company, not the state. And so what we tried to do in the papers with Robert and Abby and with Robert was to try to see, do firms change the way they report financial performance depending upon the likelihood that the state will intervene in their business. And Christian has a similar paper in the context of Indonesia. And the basic results from these studies are that when there's a greater likelihood that the state will intervene, whether, again, be through some of these really severe forms of expropriation or just greater regulation, what you tend to see is firms become more opaque, so they provide less information, and the information they do provide tends to be biased. And it's biased in a way that is designed to minimize the cost that they expect to incur. So if the government is a grabbing hand government, i.e. they want to take valuable assets away from the state and put them into public funds, we show that the firms try to minimize reported income, minimize asset values, right? Basically play the game of, we're not valuable, you don't want to look at us. But in contrast, in countries like France, when you had an interventionist government that's being benevolent, kind of like what's happening in the US right now, right? What do you do if you want to avoid state intervention? Our assets are really valuable. Our income is reasonable. It's high. You actually see them taking positive adjustments, trying to inflate their balance sheet, inflate their income. So clearly, and again, clearly, at least we think it's clear, the evidence does suggest that political intervention can motivate firms to manage, for lack of a better phrase, manage the appearance of financial performance, manage their economic condition, as reported in their public financials. Where there isn't a lot of evidence is to get inside of the economies like China, where the firms are actually controlled by the state, and to try to understand whether or not the connection with state through the ownership arrangement has adverse consequences on financial reporting. There's a limited set of papers. They really kind of go down two different paths. The first set of papers, and again, this is not a complete list, but the first set of papers look at how do reporting choices change upon privatization. When firms go from being truly state-owned enterprises to something where there's just a residual state claim, the basic result tends to be the more that's floated, the more that goes into foreign investors' hands, the better financial reporting becomes. So there's kind of some argument there that shows that the residual political claim does exert a negative influence on financial reporting practices. The other stream of literature has actually looked within China and shown that Chinese firms do tend to engage in a lot of state-controlled Chinese firms tend to engage in a lot of related party transactions, loans, purchases of raw materials, labor costs, that are used to prop up financial performance, to meet some very bright line regulatory requirements to be listed and to have rights offerings. And so there does appear to be some evidence of earnings management in these contexts. And here, unlike the sort of the distributional evidence that Peter was talking about earlier, researchers have tried to actually look at actual contracts and actual transactions to say, boy, don't these numbers look large, or isn't it interesting how this transaction popped up in a period when there were capital market incentives to meet some kind of listing requirement to have a secondary offering. What we're going to do in this paper is try to take a slightly different tack. We're not going to examine earnings per se. We're not going to look at financial numbers per se, but we're instead just going to think about information flow, almost like a disclosure type story, and try to see whether or not the state's involvement in the economy and state ownership can influence the flow of information into the marketplace. And we're going to do that by looking at whether or not Chinese listed firms suppress negative information around distinct political events where we would argue the costs of releasing negative news is relatively higher to non-politically sensitive events. And then, again, we're going to focus it in one country for some reasons I'll talk about in a moment. Ahmed, yes?
Yeah, industry is no different. It's not cooperation. It's not, as you said just 2 minutes ago, I'm shaping my financial reporting to protect myself from political intervention.
Right. Well, here you are the political. Oops, sorry. You are. Cooperation is such a positive word. Let's say it's collusion. What you actually have is a case of where there are several different layers of politics that are going to be in play here. There are the firm managers who may or may not be politicians, but may have some personal objectives to maybe get a new job, to be promoted, or just to be rewarded. There are local politicians who may run the firm, most likely not, but who are responsible for the firms under their control, and they themselves are evaluated for the performance of the firms under their control. And then, of course, there's sort of the provincial level and then the central government level who may have objectives, perhaps with respect to foreign investment, where they would like to see certain performance targets met, or within a certain province, we're promoting marketization, we're promoting foreign investment. We want these areas to succeed, and therefore, even if it's not explicitly stated, manage earnings upward or don't disclose bad news, there could be a pressure to think that, well, this is going to please higher ups if we are successful, because it's in line with sort of the goals of either the national government or the provincial government. But I'll talk a little bit more about that. But you're right, it is a different story. And that's what sort of separates this paper, right, from the earlier ones. The earlier papers are about, I'm a firm operating in this environment, but the environment is exogenous. There's a state. The state has a grabbing hand. I have to operate in this environment. How do I respond? It's a cool question. That's why we worked on it. But here you're looking at, like you said, a slightly different form. Here's a state with objectives. Here are some firms who are controlled by the person with, or by the entity with these objectives. Does this relationship influence the reporting decisions? And of course, that relationship can be very strong or can be very weak. And we're going to exploit some of the variation in China to try to show what happens as the relationship strengthens or weakens. Let me kind of go to that. So here's the slide for the young faculty, at least one of them. And that is, why did we choose to examine political forces? And why did we pick China? There's actually subtext to all of these questions. The first is the political force question. Why did we examine it? Because outside of the Western markets, and particularly the US-UK markets, political forces are frequently, or political factors, are frequently one of the largest determinants of economic behavior. And it's an important corporate finance, governance-related question. How do these forces shape market development? And so we think that it hasn't been examined well enough, particularly from an information flow perspective. And so what we're trying to do is recognize that this is sort of a missing link in the extant literature. The bigger question is why do this in China? And anytime you're trying to address a question like this, you're faced with several different research design choices. One choice could have been to take the route that Robert and Abby and I used in some of our prior work, which is the cross-country approach. Let's look at many different countries with many different types of firms, with many different types of governments, and try to do some associations at the country level, or using a panel of firms that are domiciled in a set of different countries. And that's frequently a really good route to go, but it does have a problem, and that is, as you move from country to country, there's more than just the political forces that are changing, right? The legal system is changing, how the exchanges are run is changing, level of investor interest is changing, capital flows are different, banking system is different. I mean, basically the entire economy is different, right? And so you have all these unknown variables that have changed that could be correlated with what you think is your variable of interest, sort of the strength of political involvement. And so you have a correlated omitted variables problem, and then nobody believes your results. So we decided, well, maybe there's a better way to do this. And so what we tried to do is we tried to think about, well, what are some of the countries in which you actually have state control of assets and political forces are strong? And the one country that came to our mind immediately was China. Now, it didn't hurt, of course, that TJ and Tianyu are in Hong Kong, and so I think their focus is obviously naturally looking north, but it clearly sort of fit the bill as a setting where political forces matter. And the vast majority of the firms are state-controlled that are publicly traded. And I think in the context of China, if you look at the Shenzhen and Shanghai Stock Exchange, close to 75% of the listed firms are still state-controlled entities. And of that 75%, they account for about 90% of market cap. So it's a dominant part of the capital market system. And if you're an investor thinking about investing in China, you are most likely going to encounter the problem we're trying to examine, and that is state ownership and political incentives. The other reason that we chose China is there were unique events that we thought we could examine, observable, politically charged events. Most particularly, the National Congress that occurs every 5 years. There are promotion events at the provincial level that we could observe, and there are corruption investigations that are ultimately revealed. And we felt that those events could induce some incentives to suppress negative news. And then the last reason was China's a big country. And I don't mean that in the bottom point about it's significant economically, but it's large, and there's a lot of variation in the context of China. Across the provinces, there are differences in market orientation. Some provinces are geared towards market liberalization, market development, pro-capital markets, whereas other provinces are still very much focused on issues like full employment, where value maximization isn't the principal objective of the local politicians. That right there is an important thing, right? Because it tells us that we can run a within-country test so we can keep all of our fundamental institutions constant. Legal system is PRC, regardless of where you're at, right? But within the context of individual provinces, the incentive of a provincial-level politician to care about good performance or not will vary. We have variation in our sample within the country. If you're a politician, if you're a firm operating in Shanghai, you probably face different capital market pressures than if you're a firm operating somewhere in the western part of the country. Coast versus inland. And that's something we want to exploit. There's differences in the amount of investor protections. There's differences in the amount of foreign interest across provinces. These are going to give us, again, some predictions, or at least allow us to make some predictions about where the cost of reporting bad news could be high and places where the cost of reporting bad news are going to be low. And there's also differences within the firm level. Differences in ownership structure, differences in where the shares are issued, namely, are they listed in Hong Kong or not, as well as differences in the degree of political connectivity. You could have two firms both operating in Guangdong province. One happens to have a strong connection with the local politician, the other doesn't. Would we expect them to have the same incentive to, for example, suppress news? Possibly not. The one that's connected probably has the most to lose if bad news comes out, or if somehow creates an adverse effect for his political mentor. Obviously, economic significance played a role in trying to decide what market to look at. What we're trying to do is illustrate that it's the underlying institutional environment that shapes the behavior in the context of a set of rules. And that's something that I think we hopefully can speak a little bit to. And then the last reason we chose China is because, and again, this is going to sound pessimistic, but it's not meant so, thinking of it from an academic perspective, is that there appear to be governance conflicts in China, governance problems. And these problems have created inefficient behavior. There's a beautiful paper by Alan Chang and Chang that show that state-controlled entities underperform entrepreneurial firms in China. And there are actually some other papers that go a step further and say that all of the growth in China that has occurred in the last 10 years are the result of non-state-controlled firms. That it's the entrepreneurial sector that has driven this growth. Well, if that's true, what does it tell you? It means that there's a bunch of managers and politicians out there who really do have stuff to hide. Bad investment decisions, negative NPV projects, projects that should have been abandoned a long time ago but continue to run. Basically tells us we have a setting where there's at least a likelihood that bad news should be coming out periodically. And now we're going to try to basically use a firm as its own control to see, are there periods when bad news does happen? And then are there periods when there probably was bad news, but just surprisingly it doesn't come out? So, background, I'll skip through this here. Really interesting, as you'd expect. The information environment in China is actually quite poor. TJ and I are actually in the process of doing a summary of sort of the information environment in China for NBER. And I was actually shocked when I started looking at the survey evidence and the market evidence. But for such a large economy, I mean, it really does have one of the more opaque information environments of the world. For example, Mark Young and you look at synchronicity, co-movement, and returns around the world, and they find that China ranked second in co-movement. Second only, by the way, to Poland, which is sort of my nationality. So I'm standing in good company here. But you can kind of see that no matter how you slice it, they appear to be very opaque. And I think really sort of at the heart of it, I just really want to know, is this opacity due to political pressures? That's sort of my long-run takeaway that I hope to be able to answer. Anecdotally, there's all kinds of evidence to suggest that bad news is suppressed, and I'm overstating this a little bit. But if you do sort of survey popular press, and it can be popular press in the U.S. or popular press in China or popular press in Hong Kong, the quotes kind of speak for themselves, right? Whatever the issue is, there appears to be a tendency to not release negative information in a timely manner. Now, that's not always true. I mean, obviously, there are certainly instances where very timely information is released. I think the Sichuan earthquake was a really good example of immediate transparency about what's happening. But you certainly see in the case of SARS and bird flu, information got out, just took a little longer than maybe the World Health Organization might have liked. In the case of the tainted milk scandal that happened right before the Olympics, I thought this is sort of an interesting quote from the People's Daily. There appears to be evidence. These are quotes from inside of China. This isn't the New York Times trying to make it up. That basically, the firm knew about the problem. They told local politicians there's a problem. They just happened to tell the local politicians about 4 days before the start of the Olympics. And for whatever reason, whether it be rational or not, the local politicians decided to sit on the information until after the Olympic Games. And the quote that came out of the People's Daily is the reason they did it is they didn't want to create a negative influence on society. We take that as translation of this is China's, one of its most important moments in the last several decades, and we don't want to now start having the news coverage be focused on a negative event as opposed to a positive event. Similarly, there's been a lot of evidence to suggest that macro statistics have been fudged to try to hide bad news. Now, this is fairly old. I mean, we're talking about 10 years ago, and in the context of China, 10 years is a long time, given the pace of market development. But at the time of the Asian financial crisis, China didn't report a downturn. Subsequent analysis of the data shows that it did have a downturn. It's just that at the time, the country really wasn't transparent about the extent to which it was being impacted. And that's the kind of event we're talking about, right? These are all instances where the news eventually does come out. It's just that it was temporarily halted. The flow didn't occur when it should have. It was delayed and then ultimately was released when there's sort of overwhelming pressure or just leaks out. And so we're interested in, does this tendency tend to spill over into the financial reporting regime? Because, again, my goal as an academic is to be able to teach students how to value companies. If I'm covering a Chinese case in my class, the students have to realize that all the information may not be there, and they have to form expectations in light of the fact that they may not be receiving information about the full distribution of outcomes that are taking place. So, kind of go back to sort of theory 101, why would a firm release negative information? Now, if you've read the journals, you tend to get flooded with these market demand and contracting-based explanations for why companies are going to provide information, good or bad. In the case of it sort of at the economy level, the reason transparency is so beneficial is because of all the monitoring arrangements that can be implemented. We can monitor the shareholders, we can monitor politicians, we can monitor managers, we can limit the consumption of private benefits by providing information in a timely manner. At the market-wide level, more information just means lower information gathering costs, less information asymmetry. More information improves capital allocation at the country level, right? You know where to place your money because you have better ideas as to what the rates of return are in various industries. All of this transparency has been shown to kind of map into foreign direct investment. Foreign investors like transparent environments. And obviously, if you have more capital flowing into the country, now you probably have lower cost to capital and enhanced market development. So if you think about any country, and again, China's our topic, but this applies pretty much all around the world, transparency should be a good thing for economic development. It's something that countries should want to embrace, all else equal. Moreover, from the market demand side, once you have foreign investors, they're going to just demand more and more, particularly if those foreign investors are from the US or Europe, where they're used to fairly transparent financial reporting regimes. And then lastly, kind of a China-specific point, the pyramidal ownership arrangement that's used may actually also create an incentive for disclosure because you're creating some asymmetry between the firm and the ultimate stakeholders, and this asymmetry would cause a demand for information to be produced. So in all cases, there's a lot of prevalent reasons as to why transparency should exist amongst Chinese firms, whether they're owned by the state or not. What we argue in the story, and I realize it took a while to get to this, but what we argue in our paper is that there's, of course, a countervailing force. Research isn't interesting unless there's a countervailing force. And the countervailing force here are the political factors that are in play. First and foremost, managers and local politicians will incur a personal cost for reporting bad news. That cost, for the most part, arises because of the promotion process. Political promotions frequently occur on the basis of the performance of the firms under their control. And so obviously, if I'm a local politician and I want to get promoted, I want to make sure that the firms under my control are doing well, either in reality or at least on a reported basis. Second of all, bad news can have a material impact on foreign direct investment. You can undermine investor confidence, perhaps, if you're reporting bad news. It could perhaps be a cultural issue, a loss of face. You don't want to report the bad news simply because you're dealing with outsiders. It shows weakness, and that you may want to try to avoid that. There's also the notion that if bad things really are happening, politically astute managers are going to use discretion to try to hide the inefficiencies, right? I mean, we talk again about one of the fundamental arrangements. This is Schleifer and Vishny. One of the fundamental problems you have when you have majority shareholders and minority shareholders is there's expropriation, there's agency conflicts. Perhaps when we have these agency conflicts, the firms use their control. The state uses its control. The politicians use their influence to avoid releasing information that is suggestive of these problems. Projects that go bust, projects that are negative NPV, projects that require additional funding because they're underperforming. Yeah, Ben. Sure. Sure. Right. Oh, yeah, absolutely. I mean, you do have there's a couple issues embedded in there, right? If you have a firm that's spread across multiple provinces, is the politician in the home province absorbing all the risk for all the provinces? I don't know the answer to that. But it's an interesting point. In terms of what statistics are they being evaluated on, there's several. I mean, one of it obviously is economic growth, which has nothing to do with accounting performance, right? But it's clearly they could be evaluated on GDP growth and things like that. There's also list of returns on the stock exchange, right? Changes in market value from period A to period B. Well, that's going to be correlated with financial performance if you believe that there's some association between earnings and returns. So clearly, there's at least from a correlated basis, stronger performance will mean stronger stock price performance, which they can get evaluated on. There's also, do they get evaluated on the extent to which the firms, don't deregister, don't delist, are able to have additional share issuances, the extent to which more foreign capital comes in. Those are all events that are influenced by the reported performance of the firm. Well, GDP was falling. That was back in the 90s, but Would I repeat the question? The question from Michael was, but GDP is falsified, so then. Would I find the result? Well, we don't use GDP in our model. I mean, we don't regress with GDP. So in this paper, no, in this paper we don't use GDP. But I'll actually get to the model. That's a good point. Yeah, we're actually going to look at the distribution of returns as our way of doing it. But actually, let me just move right to that. So anyway, these are the factors that we think could create an incentive to suppress information. I think Michael's question actually tells me I should move on a little bit to get to the research design itself and how we actually implement this. What we do is we look at 3 political events, and we try to see whether or not, and take this right now as a construct, we try to see whether or not the amount of bad news coming out during these periods is less than observed in non-politically charged periods. And the 3 events we focus on are a national event, the National Congress, promotions at the provincial level. We look at firms that were under the control of a politician who was recently promoted. So obviously during that evaluation period, that politician had an incentive to make sure that the firms under his control were doing well. And then we look at firms. We look at provinces where there was a corruption investigation, where a leading politician, kind of a regional politician, was being investigated for corruption. And the idea there is if you're being investigated, of course you're going to try to squash any bad news about yourself or about the firms you're working with or you have relationships with in order to hopefully make the corruption investigation go away. And so those are the events that we're focusing on. I think what's to Michael's point is, well, how do we go about and do this? And from a timeline, the idea is pretty straightforward. You can observe what happened before the political event. Then there's a period in which the incentive to suppress is heightened. That's these political events. Ultimately, that tension releases because the event's over, and news that might have been delayed now comes out. So basically, you have a period of minimal negative news followed by a period of greater likelihood of news coming out. It's a notion of suppression and then release, and then you fall back down to sort of a normal state of news arrival happening in the economy. What we do is we try to measure news over this period. And the way we do it is by looking at the extent to which there's a significant stock price drop occurring for individual firms. And we use several different measures. They're all out of the finance literature, and they're all highly correlated. But we basically look at the negative skewness of returns or negative volatility of returns, or just was there a large stock price drop. And the notion that we're after is that when there's no political event, every once in a while in this pre-period, firms are going to report bad news. So there'll be a significant material negative stock price effect happening some firm in some province. The minute you move into a period such as the National Congress, the incentives are in place to not release negative news. Therefore, stock prices don't fall during this time period. Once the Congress is over, if there had been a bad event like tainted milk, it now comes out, and not only do you get just sort of the normal rate of bad news, but you actually have a heightened rate, where news that should have come out last month finally comes out this month, as well as just events happening this month. And then it drops back down to sort of a normal level of disclosure. So really what we're examining is just the likelihood of a negative stock price fall. That's our proxy for information flow. It gets away from some of the problems of, well, how do you measure discretion, discretionary accruals, earnings management. This isn't about the financial reported numbers so much as just the flow of information. And we're using returns over kind of longer windows to proxy for the nature of news being released. What's the main takeaway? I think Table 5 and the related figures are sort of the main results of the paper. Negative signs on these political variables basically are interpreted as there was a reduced likelihood of a stock price crash having occurred during this particular political event window. So we see for national congresses that there was significantly fewer negative stock returns being recorded over those political windows. I think this is probably the better way to show it. This is a frequency of negative stock price crashes centered around the year of a national congress. What do you see? Prior to a congress, some fraction of firms each month have large negative stock price declines. I think in this case we measure a negative stock price decline as greater than minus 20% or more in a given week. We use weekly returns to handle some of the market frictions in place, trading halts and the like on the Chinese exchange. But you can kind of see that in the year or two leading up to a national congress, some firms have bad news, and that's okay. But then you get this window, 4 or 5 month period of time, there's no crashes in our sample centered around this event. And then the event's over, and we start to observe crashes again. At a heightened rate, by the way. I mean, at least that spike is heightened. I mean, you can argue that's statistically significant or not. But it's this whole. I actually kind of feel bad after Peter's presentation. I'm now talking about discontinuities in a graph, right? But basically, you can see that around 0, there aren't any real stock price crashes. That, to us, says something's happening during this period. Now, I can come up with a lot of alternative explanations, and I'll go through them. Trust me, I'm my own worst critic when it comes to research. But we thought that was interesting. Now, let me show you a couple other graphs. So we look at political promotions. And there you have, in the period of a political promotion taking place, we again see negative coefficients suggesting that there was a lower frequency of stock price crashes. You look at it graphically, you kind of got to read tea leaves on this one. But you can see, again, right before this is the promotion date, date 0, the 18-month period preceding the promotion, which is when the managers and the politicians are being evaluated, you have, again, a lower incidence of crashes. You get these larger spikes out here after the event, which is sort of consistent with Ginn and Myers, the subsequent release of information after it's been suppressed. This, we feel, is at least somewhat consistent with the story. But then this is the result that I love, because this one's pretty clear. These are the corruption investigations. There's your hole again, right? 1 year before the public release that an investigation had taken place, these firms aren't reporting bad news. What do we think is interesting about this? Well, there's a lot of explanations, but it certainly tells us that political time periods are different than non-political time periods, and it's impacting the price formation process. That's either because markets are functioning differently, the firms are behaving differently, or the information flow has changed. It could be any of those reasons, but something is certainly different during this time period. Yes? It's no significant negative news, where significant is defined as, I think they said, minus 20% decline in a week. There's certainly news taking place. We haven't investigated, we don't choose to investigate, and we won't investigate, is there a greater frequency of good news coming out? It's just that the incentive is about not releasing bad stuff, right? There's governance conflicts, there's negative NPV projects, there's political connections that you're trying to hide. That news doesn't appear to be coming out during this time period. But there's certainly news coming out. Now, I said you can sort of tear this apart with alternative explanations. Let's go back to the National Congress. Well, it could just be the case that this isn't about firms suppressing news. It could instead be about the fact that during this period of time, the machinery is such that all we're talking about are the good things that are happening, right? Because this is a period of when new political agendas are being set, new economic policies are being set, new members of the executive committee are being chosen, new objectives for the next 5 years are coming out. It's all forward-looking. It's all positive stuff. This could just be the place that the market is so dominated by macro news, and I think Mork Young and you sort of show that, right? That's what's driving the result. It's not about firm-level information. That's certainly a competing alternative. Yeah? Mm-hmm.
They know this is happening.
Okay.
So my curiosity is that when this is happening,
Mm-hmm.
there should be more information asymmetry, there should be more impliable intelligence.
Yes. Yes.
So are you able to show something of this sort?
We haven't gone down.
It's really like whether the investors
Recognize that this is happening.
And what you think part of it we say that the investors know.
Mm-hmm.
But in your case, in this kind of case,
Mm-hmm.
I think actually ordinary Chinese know
Mm-hmm.
about this. So my curiosity is whether they incorporate this.
I think that's a really good point. We haven't looked at it, but we certainly could. I mean, well, the corruption wouldn't have been revealed, but the promotion is known. The promotion is usually known. It's a fairly observable event. I wouldn't say everybody knows, but people know. I mean, there's certainly a set of constituents who know. And correct me if I'm wrong.
The promotion, though, and actually the corruption actually is sort of like the tranquil period before the storm comes.
Right.
And that is also very well known among Chinese.
And so if that's the case, then all of these are observable signals before our date 0. And so I think Bernie's question is a good one: is does the market adapt?
What is the real impact of this if the investors,
Mm-hmm.
knowing this and still do not incorporate this into their behavior?
Oh, that would be a fascinating result if we actually find it. We haven't gone down that path, but I suspect we will, because it is ultimately I think the real crux of the question from a market.
Do you have turnover and liquidity data?
We don't. Well, we have access to it, but we haven't used it yet. Yeah. What I think is, your comment sort of had another tone, another message in it that I think is really important, and that is, well, this is self-evident, right? We've kind of expected it, and everybody knows. Where I think the results actually become, in my mind, more interesting is to now exploit the variation in the data. My intuition ahead of time would have been the same as yours. Of course we're going to find it. That was actually one of the attractiveness of the project, was I knew that our first result was probably there because it just seemed self-evident. But now it's like, can we have a better understanding as to where it's most likely existing and where has it been attenuated away? And I actually thought that the problem was going to exist outside of the sort of the main financial sectors. That if I went and looked at the regions that have less regulation, more market development, more foreign direct investment, I actually thought that would be the case of where I wouldn't have found the results. But it's also, those are the markets where the cost of releasing bad news are actually the highest. And so for us, I think one of the principal results that caught us by surprise, and at least caught me by surprise, was that these political effects are actually much more pronounced in the settings where foreign investors are investing. It's in the market-oriented, value-maximizing, strong-performing provinces. That's where the suppression occurs the most around the political events. The time period is, I want to say, 2001 to 2007. Ish. Mm-hmm.
What I am really curious to, if I repeat this, fast forward to 2007.
Mm-hmm. I don't know, but we will certainly.
You can easily go to Wall Street Journal and find all kinds of anecdotal stories about people becoming more sophisticated.
Mm-hmm.
It's easier to be taken in 2001, but the Chinese market is different in 2017.
So really, though, what you're advocating is these statistics may not change, meaning the firms may still be. You think that this regression's result will change? Okay. Okay.
When we're talking about a dynamic changing market,
Mm-hmm.
it's very important
Mm-hmm.
to track,
Mm-hmm.
at every part of the window,
Mm-hmm.
how the performance is.
Mm-hmm. And you know what? If that result actually did show up, meaning, let me rephrase that. If we actually ran the regressions for 07 and 08, and the results go away or they're attenuated, that's actually great news, right? Because now we can study what has been implemented to alleviate the problem. Because if these results go away in China, that's not the end of the story, because there are a host of other countries that face this exact same problem. Now we can learn what can be done. So no, I think it's a great suggestion. And as with all research, right, you sort of, as it drags out, we get more data. And so this is good. Yeah. Mm-hmm. Well, it's corruption with respect to this, right? With respect to the release of information. And, I mean, that is sort of, you're shaking your head. Yeah.
Almost like the corruption is basically very often a political maneuver.
Mm-hmm. Mm-hmm.
A change of regime, a change of new people get caught.
Mm-hmm.
It doesn't mean that those who are not caught are not corrupt.
Oh, absolutely. I mean, corruption itself is endogenous, right? And so that's the big problem with the corruption variable. But what Peter's referring to is Peter, right? Yeah. What Peter's referring to, though, is there is this notion that the information environment could undergo a dramatic shock the minute you have successful prosecution of this type of behavior. And that's something that's been lacking so far, is the actual enforcement. The rules are great. I mean, when it comes to financial reporting, the rules actually look really good on paper for Chinese firms. The problem is they're arbitrarily enforced. But once you get credible enforcement, and that may be what's happened in the last 2 years, once you have credible enforcement, then the entire game is going to change. Let me quickly go through and just sort of highlight a couple of the other things that we look at from a research design point of view. And the first is we also look at variation at the firm level, and that is this notion of political connections. And we find that the effects are stronger if there's a political connection. Professor Young.
Quick question.
Sure.
What's the economic significance?
What is the economic significance in terms of the previous slide? Oh, boy, I've done this calculation, but it's been a while since I looked at it. I want to say it's, but bear with me. I believe it translated into something like there was a 15 or 20% greater likelihood, or lack of likelihood of there being information released. I mean, it was economically meaningful. Wasn't maybe as large as I actually thought it was going to be, but it certainly was meaningful. Yes, got it. Okay. We also look at political connections, and we see that some of the effects are more pronounced when there are political connections. I actually think, though, that the most interesting set of results are we try to benchmark against 2 other types of firms. We look at those firms that also have a Hong Kong listing The argument being that with the bonding effect, maybe these firms are less sensitive to political influence. We actually find the exact opposite, that around the National Congress event, they're more likely to not release negative news. The story there is that these are the firms that are most followed by the foreign investment community. They're kind of bellwether stocks. They're large, high-profile companies. If anybody reports a loss and it's going to get reported, it's these types of firms, and so they tend to be the ones most sensitive to the national event. Hmm? Mm-hmm. 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 That's interesting, because it tells you that at least the Singapore market isn't acting as a bonding platform. That's interesting. Yeah, that's interesting. Yeah, yeah. Okay, that's good to know. So that's actually really good to know. I'll have to look into that. We'll look into that. But we think the other interesting set of firms to work against are, what about the family firms, the entrepreneurial firms in China that don't have the direct political ownership? To what extent do we observe similar phenomena? And it actually turns out that for family firms, we do have a negative effect around the National Congress. So they, too, appear to be influenced by the same pressures that influence state-controlled firms around this sort of highly visible national event. What's lacking, though, are any relationships around the provincial level events, the promotion of a politician, the corruption of a politician. And that makes a lot of sense, right? Because they're not under the direct control. The politicians aren't being evaluated based on the performance of entrepreneurial firms. The link between firm behavior and political activity is not separated or severed, but is certainly weaker amongst these firms. And as a result, we don't document any impact of the political events. But you talk about the other alternatives, well, maybe you just don't have power, but there was certainly sufficient power to find it for the national event. So we really do think that this lack of significance is probably a real statistical result. Yeah? Okay. Mm-hmm. Okay. I haven't thought through the risk question, or the risk issue. I think it's a good comment. I'll have to think about it. The comment's well taken. Yeah. The state-controlled banks. It's an interesting question. Most state-controlled entities, not all, but most state-controlled entities actually receive their funding from the big four state banks in China. And so you do have the case of the debt holders and the ultimate shareholders are, at the end of the day, the same entity, effectively. It's the People's Republic of China. And so the incentives of the two groups are probably very well aligned. The state banks, and correct me if I'm wrong, but the state banks are national institutions. They're not provincial level. And so to some extent, they're the same as the ultimate owners of the company. I don't think that they're going to have different incentives. They're effectively not evaluated in the same way that the politicians who control these local companies are. They don't care. The promotion event doesn't impact them, or they don't impact the promotion events. Why would they monitor? They're typically I'm being a little pessimistic here, but they're typically the source of much of the tunneling that takes place in China. I mean, they're the other side of the problem. You know, what is it? Charles Lee and two of his former PhD students have a paper where they look at the prevalence of related party loans in China. And I mean, these loans are coming from the state banks. There's another paper that says that the way that money, foreign money, goes out of listed public firms, listed companies, is through related party loans. So it seems like they're facilitating the governance problem. They have no incentive to monitor the problem.
Maybe at the overall level, they are doing the economics, but we also the event specific. So leading
Right.
up to the event, they're having the same bad monitoring. Here they should be having even worse monitoring, or unless you say that.
Well, and if it's worse monitoring, you're going to get the same result. Then I guess is what you're saying, because the monitoring slacks off at this particular point in time. Yeah. I'll have to think a little bit about the role of the banks. Good point. Yeah, Charles. Right now, it is a dummy variable. Yes. No, that's absolutely. No, that's absolutely. You're absolutely right. I mean, there's all kinds of anytime you have clustering, right? You have issues of isn't this just correlated with other economic events? I mean, I can't argue that point. We don't rule it out. But it's also the reason why we look at the corruption investigation. It's the reason we look at the political promotions, because those are neither time clustered nor are they provincial clustered. They're basically, I don't want to say randomly, but they're occurring at random points in time in different provinces throughout our sample. And so, you know, the goal of our paper is not to say it's Congress yes, promotion no, or vice versa. It's to say during political windows, is it more likely that state-controlled entities face an incentive to hide information? These are just events we tried to identify because we felt that they were politically charged. I grant you, the National Congress, huge correlated omitted variable problem. Much like any study that uses, you know, an indicator to capture an event. I mean, I know you have a study looking at Reg FD, if I remember right, and that's sort of it's one event at a time. You try to look at cross-sectional variation in it. Same kind of deal here. We take an event and we look at, you know, cross-sectional variation around that event. But we hope that our other two events, because they don't have that problem, we can at least say whatever's driving these results is common across this event, and this event. Yeah, we have some data and a project underway where we're trying to look at news dissemination, kind of what are the events that are, you know, this is just stock return distribution, but that's driven by other things happening, disclosures, news stories, financial reports being released, and we're trying to dig deeper into the context. And I think what you're hearing from the questions, yours included, Charles, is that there's really sort of two questions that need to be answered to make this believable. The first is there some kind of market consequence of this behavior? And that's kind of in the line of Professor Young's comments. Do we see the market recognizing or not that there's been a change in the information flow, and is it price protecting itself? And then the second comment is, well, how does the firm get away with this? How do they do it? What's the mechanism, if there is one, that causes the stock return distribution to change over this period? Is it information events, or is it just behavior? I mean, the other alternative story that could explain all of our results is just that during these politically charged periods, firms force their employees to work harder. Managers exert more effort. Therefore, the firm produces more. They're more productive. They don't allow failure to occur. Incentives got ratcheted up, and therefore outcome, productivity goes up. I mean, that is an alternative explanation, but it's obviously being fueled by the environment. And we have to separate that out, and we know that. And I think your kind of question sort of leads to that. Oh, I'm sorry, Kevin, yes. I'm completely left justified at this point. That's okay.
One other possibility, firm or
Absolutely.
By going through the fund managers,
Yep.
by bribing the public firms.
Yeah, we've actually tried, and this is the hard part. That explanation has been brought to our attention before, that it's basically market manipulation that could be leading to this. Shockingly, we can't get a lot of data to try to test that. And so right now, it's just a caveat that we have to face. Maybe more transparency, we'd be able to identify, try to see what the various fund managers are buying, at what time are they choosing to buy. It's just alternative explanation. There is insider trading data. I'm not sure that it's good insider trading data. I'm not sure it's high quality at the moment. But we could certainly try to look at that. And we could. I mean, that's been sort of one of the problems we've had in terms of getting this project rolling. Just the data set of Chinese financial data has gone from being less reliable to finally reliable, and we're at this time period of everything's evolving. The quality of the data is just getting better. The last time we looked for insider trading stuff, the coverage was very spotty, and we were afraid, kind of in this notion of dropped observations. Here's what we see, but what don't we see? And there could be a lot of endogeneity associated with who's reporting and who's not, and who's being on the tapes, on the data tapes. Yeah, go ahead. Absolutely. Absolutely, and I'm not going to name names, but I know of at least one hedge fund that has an office in San Francisco that exploits this opportunity. So, yeah, we could certainly. That'd be another paper. No, that'll be an investment account first, then another paper. Question. Okay. Yes, that's okay. Yeah, absolutely. The explanation is, in some sense, it's cultural, and this is going to sound weird coming from me, but I'd rather TJ were up here. But there is sort of a relationship. Family firms still have relationships to the country. They still have they seek political influence. They seek political connections. They still want contracts. They still want licenses, and there's also just a general cultural time period of this is a period when the whole country wants to put on a unified front. And so, there could be social pressures besides even the political pressures to just conform. Again, I'm probably not the best person to speak to that, but I think that certainly is something that could be existing. I want to wrap up. I know I'm probably out of time, aren't I? But I just want to show one chart, and it's because of Peter. Peter inspired me here. And that is, the previous talk was about earnings management, or at least about can you use distributional graphs to detect earnings management. And I'm intimately familiar with Peter's work in this area, and I think it is a really compelling set of papers that what we see in Bergstahler, Dechev, it is not earnings management. It's a statistical artifact, scale and sample selection criteria, along with all the other benchmarks. But I'll come back to that. But there's another chart I want everybody to look at. There's a similar chart, I say similar in terms of people have looked at the distribution of ROE amongst Chinese listed firms. And somebody asked the question, I was in the back of the room so I couldn't see who, but somebody asked the question of are there other settings when you could perhaps use distributional data to at least try to infer the presence of earnings management? And this is what the distribution looks like for Chinese firms of ROE. Now, a cynic could say, well, but ROE, they don't target ROE. They target EPS, they target this. But in China, they do use the deflated number. It's a very important statistic because listing criteria, by law, are a function of the firm's ROE. You report 3 years' worth of losses, you're delisted. But more importantly, if you want to offer additional shares, you have to have an average ROE of 10% over the last 3 years, and no ROE in any year could be less than 6%. And the data in China is really consistent with firms behaving in accordance with that statutory requirement. Now, there is self-selection here, who comes to market, who doesn't. Obviously, why are there no loss firms? Well, why come to market if you're going to be a loss firm? Because you're just going to get kicked off the exchange. But you do see these interesting spikes around the regulatory rates. Is that evidence of earnings management? No. No? What was that? It's integral accounting. I'm not going to say it is or it isn't, but we talk again about competitive advantages. This is an institutional quirk, and it's changed over time. It was 10%, then it was 9%, then it's 10%. It's bright line rules that have a cost associated with them if you fail to meet them. This is the type of setting where this isn't prima facie evidence, but it's at least a way of thinking about maybe there are some other settings where we can use frequencies and the like to try to infer the presence of earnings management. Okay, the last thing I want to say, and I realize I'm well out of time, plus you guys are probably really hungry, is I have a conclusion about my paper that I want to share with the junior faculty. I am frequently told, sometimes by my own co-authors, it is so good that you're working on a China paper, or you're working on an Asia paper. And my conclusion, part 2, is this is not a China paper, this is not an Asia paper. Instead, this is a corporate governance and valuation paper that's exploiting, maybe not efficiently, but exploiting the Chinese environment to answer a question that's not about China, but it's about 90% of the world. It's about firms with single controlling shareholders in the presence of governance conflicts. And so this is just a setting to test an overarching question. And I think if you want to be successful using non-US data, that's the way you have to view your settings, is are there questions that you're able to answer that can't be answered using CRISP and CompuStat? There was a paper at this year's JAR conference that looked at political issues and accruals in the US environment around elections. It's an interesting paper, but it lacked a lot of power because it's a third or fourth or fifth order effect about the accrual generating process, whereas other settings, we think this one is maybe a much more poignant way of just really getting to the political issues and how they impact. Well, it is a Chinese. Mm-hmm. True. No, I agree with that. Yeah, absolutely. I was just trying to make a slightly broader point, though, but point well taken. Thank you for your comments and questions. Thank you.